something that I say to people constantly is, if you're looking at an education savings plan for a kid when they're sort of, just starting school, or even when they're still, a baby, a toddler, it's almost impossible to predict what they're going to do with their education, in 15 to 18 years' time. So, I prefer to talk to people about using a different strategy, still absolutely having the discipline of saving for their kids' education, but using something that gives them a lot more flexibility and provides income and like future passive income for your kids well beyond their education. Because I think for me, the biggest flaw in the idea around an education savings plan is our kids' need for money is going to go beyond just their education.
Hey, what's going on, cash flow hackers? It's Chris with Life 180, and I am back here talking about some Canadian fun financial content with Liz Lamond, who is up in Canada. And Liz and I are doing some work together. And today we're going to be talking about RESPs in Canada. And are they a good way to save for your kids' college? Or are there some alternatives that are better? And so Liz, I'm going to tell you, I'm out of my expertise zone here talking about this stuff in Canada. So I'm going to just hand this over to you and let you talk about it. And then you and I can engage when it makes more sense, when I know what I'm talking about.
So RESPs in Canada for kids, and it's money that you can put into these savings plans up to the age of 18. Okay. And there is government matching available. So something to understand about the government matching piece, though, is that they will match 20% of the first $2,500 put in each year, up to a maximum of $500. So they don't match beyond that. And then the lifetime maximum of how much they'll match is currently $7,200. So even if you put in more than that, the most the government is ever going to contribute into that plan as well is the $7,200. Now, at the point when your child starts their post-secondary education, that's when you can start to make withdrawals for the use of that money. Now, it needs to be with an educational institution that's recognized to be able to use that government matching portion. So something that is really important to understand is that if your child decides to not go with a traditional educational institution, then you may not have access to all the money that you're expecting. So certainly your portion that you've contributed will be available, but there are some limitations around how that's used. So just making sure you really understand what you're setting yourself up for. So something that I say to people constantly is, if you're looking at an education savings plan for a kid when they're sort of, just starting school, or even when they're still, a baby, a toddler, it's almost impossible to predict what they're going to do with their education, in 15 to 18 years' time. So, I prefer to talk to people about using a different strategy, still absolutely having the discipline of saving for their kids' education, but using something that gives them a lot more flexibility and provides income and like future passive income for your kids well beyond their education. Because I think for me, the biggest flaw in the idea around an education savings plan is our kids' need for money is going to go beyond just their education. And it's also going to go beyond, describing what that education should look like. Like the education landscape is constantly changing in terms of what people need to be doing for their careers, what they're changing. And it's impossible to predict what that's going to look like in another 15 to 20 years for our kids. But what we do want is we want to have capital available there that they can use for their education or whatever else they're planning to do. So maybe it's to start a business or to do something else, or have an experience that we think is going to really enhance their learning at that stage of their life. And so creating something instead that gives them that level of flexibility to have that capital available is just so much more powerful than what I believe you can do with an RESP and its restrictions.
All right, so that's a lot to unpack. So it's very okay. So I will say this, based on how you described it, it's obviously the limits and the contributions from the government, and there's some things that are different, but it's very similar to what we would call a 529 account in the United States, which is basically a college savings account plan. That said, some of the things that you said as far as numbers go stood out to me, right? So what you said with the government contributing 20% up to $500 and a maximum of $7,200 during a lifetime, right? Per student, right? And so if that's the case, let's say you're maximizing this from the time your kid is 4 years old up to 18, and you got 14 years, because I just did quick math in my head, and 14 times 500 is about $7,000. So like if you maximize like the government match, so to speak, that means you're getting $3,000 a year for 14 years, right? Effectively going into this account. It'll grow. Are you investing this money? Does this money go into investments that have risk associated with it?
So people have different options in terms of what they're doing with that. Yes. Yeah.
Okay.
So
But risk is an option.
It is an option. Yeah.
And my guess is if it's like a 529 account where risk is also an option, chances are most likely it's going into things with like mutual funds and, you know, that those sorts of investments that are higher risk. And, you know, the crazy part is like, let's just think about it. So over a 14-year period, if you did that 14 times 3,000, that means you're contributing $42,000, right, to college education over a 14-year period. Even if that performed, let's say at 7%, you still only have $80,000. I don't know about the cost of college, you know, in Canada, but, you know, in the United States, that's not going to buy you very much.
Yeah, you know, we don't have quite the same crazy fee structure, but again, it depends what your kid ends up doing. So if they decide to do medicine, then yeah, that's not going to really drop in the bucket. Yeah.
Right. Yeah. And so you hit it too. Like one of the big things that I focus on is the flexibility, right? So not when you have your money in those accounts, that money, if you want to be able to maintain, first of all, I guess I should ask a question to get clarity. In the United States, we could, that money is tied up with a 529 account. And if you ever want to access it for anything else, you're going to have to pay taxes and penalty to get it. Are you able to do the same thing up there?
Yeah, that money is, it is effectively locked in. It's effectively trapped money to be accessed when your child is ready for their education without having any kind of penalties. Yeah. Okay.
But if the child got to, you know, college age and wasn't wanting to go to college and there was no other kids to transfer it to or anything of that nature, could you pay taxes and penalty or anything of that nature to get it though?
You should be able to get the amount that you've contributed back out, but it's very likely that the government matching portion would be gone. Okay. So all things to consider. And so the big thing for me, and I have a 10-year-old daughter right now and a 7-year-old son and a 3-year-old daughter. And so we're in the thick of this personally right now. Right. And so as we're thinking about college planning and what we're doing down here in the United States, it's, you know, with the way the world is right now, especially, you know, I'm looking at this being like, I need as much flexibility as possible. Right. And I'm an entrepreneur. I've always worked for myself. I've always been an entrepreneur. And, you know, I also think the cost of college and the, like how the value of college has been diminished. Right. Not to say that college isn't great for a lot of people. And this is just my personal opinion, but if you want to go to school to be an engineer, if you want to go to school to be a doctor or a lawyer or something of that nature where you need that technical training, then college is amazing. If you want to go be an entrepreneur or do something of that nature, I would rather take money and go pay Russell Brunson, you know, $50,000 a year to coach my kid and mentor my child and put my child in a mastermind group or an inner circle group with a bunch of high performing multi-million-dollar earning entrepreneurs for 50 grand a year than I would go to send them to, you know, Arizona State University. You know what I mean? Like, and so by having money in a 529, that wouldn't be an option. But if we use some other strategies and saved in other vehicles, you know, that is absolutely an option. You have that flexibility. Yeah. And I think that's a really important point. So, you know, the strategy that Chris and I are talking about is using a properly structured whole life insurance policy for your kid. Now, people often say, hey, whole life insurance on my kids, like what? But it's using it as somewhere that you can store capital that is a growing asset for your children, not only for their education, but for the rest of their lives, and is going to give you that level of flexibility. So certainly in Canada, you can be the policy owner and your child can be the life insured. And then at some later point in the future, when they're an adult, you can choose to transfer ownership over to your children. But in the interim, this is the real power of this strategy, is you haven't lost access to capital during that time. So if you're doing other activities that are investing and growing wealth, you can also use the value in that policy that you're growing for your children to go and do that investing. But the money is going to continue to compound and grow inside the policy at the same time. So we're not giving up flexibility over that next 14 years that you talked about in our example earlier. But there's money then available at that point at 18 or whenever they're ready for their education that you could then draw on to use for their education, or as you said, their entrepreneurial dreams, whatever it happens to be. And nobody's tying that money to any requirements.
That's awesome. And the other thing that, I think is important to understand when we talk about the RESPs, the 529s, is when we talk about, the risk associated with how you invest the money in that is, we talk a lot about in retirement, we talk about this thing called sequence of returns risk, right? Like when we all know the market's cyclical, right? And so when that downward cycle happens, if in 2008 you were retired or you thought you were going to retire, and then you lost 30 or 40% of your nest egg or your retirement account virtually overnight, now you're working for another 5 or 10 years, right? And that happened to millions of people across the world, right? And it's the same thing with these RESPs and 529s. You put your money in these accounts and they're exposed to risk. You could feel really good. And what happens if your kid gets to college age and you have a bad year or two of market performance right before they go to college, now you're doing the worst thing in personal finance, like as far as rules go, is you're liquidating a negatively performing asset, which just compounds all the problems, right? And so that's another thing by utilizing a whole life policy and doing it the right way, you're taking sequence of return risk off the table.
Yeah, absolutely. Really important.
So I love that. Is there anything else about these that you think people should know about?
I think it's just about really understanding anything, including whole life, but understanding exactly and looking more than just the short term. So it's really easy to be mesmerized by $7,200, but just like work out the sums of what that means over a period of time. It's actually not that much money. If you span that over 18 years, $7,200 isn't actually all that much that's going in extra. Now, extra money is always awesome, but maybe there's a way that you can grow money in a more effective way. So really understand that when you're designing a plan for your children, just really think about not only just the next few years and not even just up to 18, but beyond, what is going to be in their best interest in terms of what you're teaching them about how to use and manage money, as well as what you're creating for them. So, having something that makes sense on an ongoing basis is, something I'd really encourage you to have a look at.
So let me ask you this question, and because I want to use an example that I would give somebody in the United States when it comes to whole life insurance, and I want to make sure it works the same way in Canada before I go there. When you do an IFA in Canada, what is the typical interest rate less than the policy loan provision?
Usually, yeah.
Usually. Okay. So I'm going to use this example then, because it's the same way in the United States. So in the United States, imagine it this way. You have two options. You could go to college and you could save in a 529 account or RESP. In the United States, specifically, what I can say is a 529 account. If I have money in a 529 account, I have to declare that with the college too. So I have to let them know that this money is there. So before I qualify for any financial aid or anything else, they're going to be like, what do you have in these accounts? And I have to tell them, and they're going to take that into account before I get any financial aid. So the more money I have in these savings vehicle, the less grants I get, the less everything else I get. So I'm effectively increasing the cost of college, right? Which is important to understand. Now I know college is a little cheaper in Canada and all that stuff, but I bet you the same thing, it would be taken into consideration, because higher education institutions are just that way. So that's one thing to consider. The other thing that I think is really important when you look at these just funding college and saving is, if you were to get there, let's say you had $100,000 that you just stashed away for college for your kids. You get there, you spend that money all because, and you did it this way because you wanted that $7,200, right? Like in Canada. And you got to look at what's the opportunity cost of that strategy, right? And that's really, really important to understand. And if I could show you a way that you could put that 100 grand in a place and that you could earn, let's say 4 to 5% on that money. And then all the while you could then leverage that asset. And it's completely, in the United States, it's completely protected in 99% of situations from being held against you on your FAFSA, which is the financial document that you got to complete to go to, submit for financial aid for college. It's the free application for federal student aid is what the FAFSA stands for in the United States. But as you go through that, I can show you a way that rather than just paying 100 grand for college, you have this asset that you could leverage and assign a cash value line of credit or assign an IFA, right? Because if you, in your mind, you're going to be paying for college anyway out of cash flow and all these different things. It's just something we do as parents, right? We kind of, it's expected of us, right? Like I'm expecting to have to do it. And I know the government's expecting me to do it, right? Like it's just, they don't really give you a choice, quite frankly, these days. And so it's just part of it. So rather than just paying that cash out of cash flow or getting another loan through traditional financing, let's use this whole life policy, get it to $100,000. And then I can take an IFA or a cash value line of credit, and I can then borrow against it, pay for college that way. All the while I'll be paying, let's say 3% interest and earning, my money will never be interrupted compounding and keep growing. So as I'm paying it back, I'm not paying the school back in the institution. This is the whole concept of becoming your own banker. I'm putting the money back in to I'm paying the insurance company back. And as I do, the collateral capacity, the liquidity of my policy gets bigger and bigger and bigger again. So now when Liz is just talking about the longer term need for finance for our kids, for ourselves, right? Like there's a way this comes into, because let's face it, Liz, there's a lot of stress and pressure on people for retirement planning, right? So there's a guy who wrote a really good book called College Planning and Retirement Planning. You can do both, right? And it's, the idea is, if I could show you a way that you could take this one account and pay for your kids' college, and then at the end of it, pay that kid's college back, and all that money still winds back up in your accounts, so you could have it there for retirement for whatever reasons you want. Like, I don't know who's not interested in that.
Yeah, because I think the thing I hear the most from parents after they've done the traditional RESP method is they say, I spent so long saving that money and now it's all gone.
I got nothing for me.
That's right.
Gone. Yep.
Yeah. It's nothing for them and nothing to pass on to their kids or anything else that they'll need when they're ready for a deposit on a house or anything else either, right?
100%. And so I think that's the real power of why you have to, if you think just myopically and linearly just on like, oh, like how do I get this $7,200 or whatever, we got to stop thinking about our financial strategies in that context and start thinking about, what do I want my money to achieve for me? What do I need my money to achieve for me to achieve the objectives that I'm setting out in life? I want to pay for college. I want to have my house. I want to have retirement planning set up. And then once you understand where you want to go, you can reverse engineer what tools, what assets you need to use to accomplish said goals, right? And so that's just where this comes into play. You just gotta think holistically about it all, I think is the important thing to understand.
Yeah, absolutely. So. And that, and thinking long range in terms of, really important of, not siloing money, because that's the way, that you're not going to get to your goals, is if totally. If you're not realizing that you could have it as the bigger picture, like you just really well described.
100%. Yeah, no, that's awesome. Well, guys, I hope you guys found value in this video. I can tell you, if you have kids and you're looking to plan for college or you're in the middle of it, this video might be the most important thing you watch all year long. Like this, you need to consider this. If you have any questions, there'll be a link in the description below. You can go down, set up a call with one of our people to have a conversation about how this might play out in your life, or how you could utilize a properly designed whole life insurance policy to help you with your college planning, or answer any other questions that you have around your money. As you could tell, we're really passionate about this stuff, very holistically thinking about this stuff to try to simplify the financial confusion in your life. So if you found value in this video, please hit that subscribe button, click the bell, that way you get notified every time we launch a new video. And as always, have a blessed, inspirational day, and we'll talk to you on the next video. See ya.